Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. Today, we'll unpack the big tax changes under the One Big Beautiful Bill Act and 5 financial lessons for kids. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Kaylee Berenson and Ryan Connor from Buska Retirement Solutions to unpack the big tax changes under the One Big Beautiful Bill Act. A lot going on in that bill, huh?
Yeah.
Absolutely.
All right. Does the Big Beautiful Bill Act change tax brackets? Because I remember in 2017, the Trump Tax Cuts and Jobs Act changed federal tax brackets for everybody. What did the Big Beautiful Bill do in regards to those?
So the One Big Beautiful Bill, it didn't really shake up the tax brackets. What it did was it made the 2017 Tax Cuts and Jobs Act permanent, and it is an index for inflation as well. So when we look at how we tax in, the U.S., we have a progressive income tax system. And so you earn more, the more you eventually get taxed on it. And there's going to be 7 different tax brackets that we have. So it ranges from 10% to 37%. So let's say you're in the 24% tax bracket. That doesn't mean that all of your income is going to be taxed at 24%. And I think that's a big misconception that a lot of people have. So that's your marginal tax rate. So if you're in the 24% tax bracket, you're going to be taxed first at a 10% and then 12%, then 22%, and then the remainder at 24%. So your net effective tax is going to be lower than your marginal tax rate. There is also a little bonus when it comes to the Big Beautiful Bill as well with the standard deduction. They did raise the standard deduction for 2025. So for single filers, they raised it by $750. And then for married couples, they raised it by $1,500. They did recently announce that in 2026, there will be an increase in the standard deduction as well. I think it's important for people to remember that these tax cuts were set to expire at the end of this year. And yes, this move does make them permanent, but I think like anything in Washington, is anything ever really permanent?
No.
Yeah, right. So, I think that people should think of this as these tax rates are written in pencil and not permanent marker. They can change down the road. In my opinion, I don't think that they're going to last forever. So, my advice to everyone would be take advantage of it while it's here, be proactive and strategize so you can maximize these benefits.
I do find that paying taxes is a permanent piece in Washington. It does seem. Okay, good. What changes to estate tax exemptions changed under this? Because I know they'd raised up the estate gift tax exemption. Did that get solidified in, or how did that work?
Yeah, so that was raised as part of it as well. So one of the major changes, similar to the changes in the individual income tax rates in the 2017 bill, one of the other major changes at the time was a significant increase in the estate tax exemption, making it so the overwhelming majority of Americans wouldn't have to worry about estate tax for really any of their
Married
assets.
couple was what, 24 million, 25 million, somewhere up there?
Yeah, so you're talking about a very, very small sliver of people having to worry about it. Now that doesn't mean that when folks come in to meet with us, they don't ask, hey, what about the estate tax?
Right.
And then, in the vast majority of cases, it's not going to be relevant for most folks. So that was still kept at a very, very high level, and not something that most folks are going to need to worry about as part of their estate planning process, is trying to maneuver ways to avoid the estate tax issue.
Right, okay. And now there's the SALT tax.
Yes.
What does the act change the state and local SALT, SALT, deduction cap? Who stands to benefit from that? What even is it?
Yeah, so let's start with the basics. What is it, right? SALT deduction, it's going to account for things like your property taxes and your state income tax. So when you file for your federal taxes, you can sometimes deduct those SALT taxes that you've already paid. And so that's what they call the SALT deduction. It helps prevent you from being taxed on the same money twice. But you want to make sure that you want to know that you only get the SALT deduction if you're itemizing your taxes. So if you're taking the flat standard deduction, then it doesn't really count for you because you're not, maximizing that SALT benefit. So back in 2017, the Tax Cuts and Jobs Act, it put a $10,000 cap on those SALT deductions. And that hit people in high state taxes pretty hard. So like New Jersey, New York, California, Connecticut.
Minnesota.
In Minnesota, sure, where property taxes can easily exceed, that $10,000 cap. So the One Big Beautiful Bill came in and they raised that cap to help give some relief to those people. They raised it to $40,000 now. There are going to be income limits, though, that people need to be aware of. So for married couples filing jointly, if you make over $500,000 in a year, then you will see that start to phase out, but it cannot go below that $10,000 cap. So the $40,000 cap, it's also set to increase by 1% each year through 2029. And if Congress doesn't act again, then it is set to drop back down to that $10,000 threshold in 2030. So the One Big Beautiful Act, it does give high state tax residents some relief by increasing that SALT deduction. But just remember, again, it's temporary, like many things in this One Big Beautiful Bill. So again, take advantage of it while it's here and maximize it and make the most of it.
What other permanent enhancements were made in that bill? Or what other things did you see in there that would benefit or potentially not benefit the normal retiree?
Yeah, so with a lot of folks, a lot of families and stuff, one of the big changes is an enhancement and permanence of the child tax credit coming in at a more elevated level. That was something that had been changed in 2021, and they actually structured it in that bill where it would actually pay out like a monthly credit to folks with kids. That went away, but with this one, they've not brought the child tax credit back to quite that level, but it is enhanced in the way that it was not under, say, the 2017 bill. Now, some other things that some folks might get some value out of is there are all sorts of kind of small things that, again, if you itemize, you can start deducting. One of the kind of ones that might impact folks, as they're, especially with interest rates still being relatively high, right, is being able to deduct car interest.
Car interest?
Yep, on like an auto loan.
Yeah.
From your taxable income.
Okay.
But again, that's only going to be the case if you itemize. So again, if you take the standard deduction, a lot of these small changes in deductions just simply aren't going to apply because
right,
you have to have enough deductions to actually make itemizing worthwhile. But
right,
if you do, go get a new vehicle or even a more expensive used vehicle, may be able to at least shave some of the pain off of those costs via that deduction.
So don't do it just for the tax deduction,
Yeah,
but you
may
may benefit for it.
you might end up saving just a little bit of money. Now, of course, there are all sorts of potential pass-through problems of maybe the dealerships just increase the price because they know that some of their higher earners will be getting a tax deduction.
Getting a new car.
Right.
Yeah, we'll see how much that actually ends up impacting and helping people in the long run, but that is one of the more interesting ones that might impact retirees. There are a lot of other changes that might impact more working families, but
right. And is there any other ones that you've seen in there or things that are pending that are interesting to look at from a retirement standpoint?
So
changing things to IRAs or 401ks, anything like that?
So within the big thing is from the taxation on those. Those are always going to be taxed at.
They are what they are.
They are what they are. So there aren't really any changes there from that perspective. The structure of that from retirement accounts is not going to change. Now there are some enhanced catch-up contributions and stuff that can be done between ages 60 and 63. So that was part of this overall package. Allowing for folks who are, very close to retirement but not quite retired yet to actually contribute, significantly more money actually into their 401ks for that little period of time. So in terms of retirement accounts, that's probably the biggest change, but it impacts a very narrow age range of people, only ages 60 to 63.
Let's take a short break and we'll come back and talk about that. And after that short break, we'll explore inflation adjustments, phase-out thresholds, and planning opportunities arising from these changes. So stay with us. We'll be right back.
And now back to our weekly question and answer segment.
Before the break, we covered the permanence of the Tax Cut Jobs Act's tax brackets, extensions of key tax cuts, and the SALT cap increases, but let's go a little deeper on that. Are the tax brackets indexed for inflation going forward, and what does that mean?
Yeah, they are actually indexed for inflation, and that's one of the key features in the One Big Beautiful Bill Act. So they're automatically going to adjust, and it's going to be based on a measure of inflation. So that's usually going to go off of the Consumer Price Index, otherwise known as the CPI. It matters because without indexing, even small increases in prices can push people into higher tax brackets, even if their buying power hasn't really changed. So for example, let's say Ryan made $50,000 this year. So it's going to put him into a certain tax bracket, let's say 12%. Well, as prices go up, gas, groceries, rent, his boss decides to give him a 3% raise to account for rising costs. Sounds great, right?
Yes.
Yes, thank you. Well, if tax brackets weren't indexed for inflation, then that small raise, is going to bump you into a higher tax bracket possibly. So maybe you go from the 12% to the 22% now, and suddenly you're paying higher taxes, even though your raise isn't actually, covering higher costs. So you're earning more dollars, but those dollars aren't actually buying him anything extra. That's what we call the bracket creep, and that's what we're trying to prevent by indexing for inflation. So you're going to see these tax brackets rise a little bit every year, not because Congress is changing the law every year, but because it's already automatically built into the system. It's good news for taxpayers because it's going to give a little bit more fairness and a little bit more predictability and some real protection in an economy that has prices always moving.
Right. So as they're making more, they're not just staying even while the tax man gets wealthier.
Right.
Fair enough. Which income levels are going to see the biggest impact, positively or negatively, from these changes?
Yeah, so the changes overall, and really it's changes in comparison, from my perspective, from what tax law was going to be if nothing passed. Because like we talked about, the brackets are largely a continuation of our current environment, but brackets were scheduled to increase almost across the board at the end of 2025 for the 2026 tax year. So the folks that are going to benefit from this the most are going to be the highest earners who saw the biggest reductions in the 2017 bill in terms of nominal dollars. But the real big winners, at least over the next few years, while those state and local tax deduction limit has been increased to $40,000, are going to be high earners or expensive property owners in higher tax, not just even states, but also localities as well, where their property taxes can be higher, their state income tax can be higher. Being able to utilize those deductions, if you had, let's say, $25,000, $30,000 in deductions to use, but under prior law could only use up to $10,000. Well, now we are increasing your tax deductions by, $15,000, $20,000 a year. So, generally the biggest benefits here are going to be at the higher end of the income spectrum or the asset spectrum, depending on what you have. But there still are additional benefits kind of throughout the bill that can work their way down to middle and lower income folks as well.
Okay. And you had mentioned something about it's permanent, but not always.
Right.
What should people be taking proactive tax strategies now? Keeping an eye on it. Like, what should people be doing?
I think you know my answer to this. Absolutely. You do want to be proactive. Now is the time to take advantage of these because you have the lower tax brackets, the higher deductions. And again, we don't know if it's going to be permanent or not. Tax law usually isn't permanent, as we know. But historically, tax rates are low right now. So yes, people should be taking advantage of that. And one strategy that they can do is through the Roth conversions. So if you take some of your traditional IRA money now and you convert that to Roth IRA, well, yes, you're going to be paying the taxes on that money now, but you're going to be taxed at a lower rate, and then you're setting yourself up for that tax-free growth in the future. If rates do go up later, then history, tells us that often they do. Right. Well, you're going to be thanking yourself in the end because you took advantage of those lower tax rates. Another strategy would be, bunching those deductions together. So simply that means that you're going to be taking things like your medical expenses, like property taxes, stuff like that. And then if you can, itemize in 1 year, you can bunch all of that together, then maybe you take the standard deduction the next year. So it's really meant to help you maximize the tax benefit from expenses that you're already going to be paying taxes on anyways. The key here is that you want to be intentional because the One Big Beautiful Bill Act, it gives us an opportunity And with the lower tax rates, the higher deductions, I mean, that window is probably not going to be open forever, as we've talked about. So if you can plan ahead and you can use today's, rules to your advantage, well, then you're ready for whatever else comes down the road, right? If we can be proactive, it's not just smart, but it's also keeping your hard-earned money more in your pocket and out of Uncle Sam's.
All right, that's always a good thing, right? Are there any hidden things, not hidden, but things that someone's not paying attention to that could surprise them along the way? Like, oops, didn't see that coming.
Yeah, so I think one of the big things that in meetings that I've had with clients since it's passed is some of it's about what's actually not in the bill. So one of the things that was a common campaign promise but did not make its way into the bill was that Social Security would just not be taxed. That's not the case. Now, there are parts within the bill to give seniors, elevated levels of standard
Government
deduction.
employees caught some out of it, right?
Yeah. And so, but in the grand scheme of things, Social Security is still taxable, so that's the big thing in terms of conversations that I've had with folks to let them know, okay, that's not part of it. One of the things that was a campaign discussion that is in it is deductions for income that classified as tips. Now, there are all sorts of income thresholds that are involved in there, only up to a certain amount of income. Then it begins, like with many of these different types of deductions, it has phase outs at certain levels of income. While the SALT deduction phase out was at a pretty substantial amount of income, at $500,000.
Right. Yep.
The taxes on tips one is around $85,000.
Okay.
That starts phasing out. And so, those are going to be ones that, might not impact everyone, might only impact a relatively narrow band of people. But we saw a similar thing around overtime where you've got, similar type things, similar phase outs, kind of pulling, kind of restricting, who can necessarily utilize those for what types of work they can be utilized for. But again, if we are aware of them, we can tax plan for those, make considerations into those, especially for folks who are not yet retired, folks who are still working. Because if we know that, okay, your income is going to be based on that, you're going to have some portion of that that's going to be deductible, then we can start talking about, okay, does it make sense to utilize some Roth conversions here in the relatively near future to kind of take advantage of this? Because, like Haley's been talking about, any tax act is only in so permanent as a law getting written to override it. And historically speaking, this will make effective tax rates quite low. Compared to other times in modern American history. And so we don't necessarily want to anticipate that by 2035 or 2038 or 2045 that we're going to be in this same type of quite low tax environment. So, taking advantage now and while the getting's good, is probably the time to utilize it.
It's at least known. Tomorrow's unknown.
Right.
True.
Good. Well, we appreciate you unpacking that for us. I know when it comes out, I don't want to read that thing. And if I do, I can't understand it anyway. So appreciate you giving us the highlights and helping your clients kind of navigate what could benefit them.
Absolutely.
Thanks for joining us today. Thank you for tuning in and watching. Have a great day.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Sue Buska from Buska Retirement Solutions, and joining me today is Ryan Connor. Now, today, Ryan and I are going to be talking about 5 financial lessons for kids.
This should be a fun conversation. Investopedia's Financial Literacy Resource Center has great resources for kids, starting from kindergarten age all the way to 5th grade. And today, we're going to go over some of those lessons so that you can get an idea of what teaching young kids about financial literacy looks like. Now, whether you're a parent, a grandparent, or an educator, this episode is one you won't want to miss.
Well, before we get started, a quick note for our viewers. Both Ryan and I are seasoned financial services professionals, but for the purpose of this conversation, I'll be taking the role of the curious listener, and Ryan will offer expert insights.
Sue, I think this is such an important topic. In 2024, the PFIN index showed that only 50% of adults are financially literate, and that number has actually dropped over the course of time.
Wow, that's alarming. I saw that same survey and it showed that among Gen Z, financial literacy is at about 38%.
I don't want viewers to think that we're picking on just one generation though. They have a little bit more time to learn. But if you can learn when you're younger, that's even better. Because if you're financially literate before you get to college, in my opinion, that can set you up in pretty good shape.
I agree. So let's start with kindergarten. What kinds of things should we be talking about with our little ones?
So with kids as young as 5, you want to focus on wants versus needs.
Well, that's smart. Kids that young aren't going to grasp compound interest.
Yeah, I don't think mine will. The first thing you want kids to learn is the basic needs of all people.
Well, that's an important lesson for kids to learn. Now, we do all have the same basic needs and understanding that is essential for having empathy for all kinds of people.
Exactly. That's a great point, Sue. Teaching kids about basic needs is a great time to introduce new vocabulary to the situation.
You mean words like shelter and clothing, along with words they probably already know, like food and water?
Yeah, they certainly do know those, but that's exactly right. Once you've taught them the new vocabulary, you can then show pictures of things like shoes, houses, Legos, and so on. You show them, the kids to ask, okay, is this a want or is this a need?
What a great lesson. Now, if anyone watching today is a kindergarten teacher, I strongly encourage you to add this to your lesson plan.
It is a nice grandparent project as well, I think.
Well, it is, and especially since kids often come to grandma and grandpa for the things that they want.
Oh, they absolutely do.
Now, let's move on to first grade. What's a good lesson for a kid who is about 6 or 7 years old?
So first grade is a good time to start talking about earning, spending, and saving money. Now, the goal of this lesson is to make sure that kids can define the words saving, spending, and earning. They should also learn whether a choice will lead them to spend money or to save money.
Well, what about the difference between saving and spending? I mean, that seems like an important thing to learn.
Yes, and that's a key part of the lesson. And the great thing about this Investopedia lesson is that it includes a fun sorting activity, where kids have to decide whether something is spending or saving as a decision.
All right, so kids understand wants versus needs and saving versus spending. What should they learn as they move on to the second grade?
Okay, so in the second grade, kids should learn about goods and services.
So you teach second graders that goods are things that you buy to keep, and services are things you pay other people to do for you.
That's right. Now, part of this lesson is to get kids thinking about what goods and services their families buy. As part of this lesson, kids read about a family that has to deal with some damage after a storm. And they have to figure out what types of goods and services the family will have to buy to help clean up and repair the damage.
I really like these lessons so far. I think it's such a smart approach to gradually laying the foundation of financial literacy with age-appropriate lessons. That way, when it's time to teach your older kids about things like student loan payments and compound interest, they'll have been thinking about these things for a long time.
Exactly. I think it's probably a lot more overwhelming to learn about more complex financial topics when you don't have that solid foundation of financial literacy to build off of. So, should we move on to the third grade?
Yes. What's on the lesson plan for the third graders?
So in the third grade, kids should do a deep dive into how to earn money. At this point, kids should be adding a new word to their vocabulary: income.
Well, that's one of my favorite words.
It should become a favorite word for kids too. Now, part of this lesson asks kids to think about how they'll earn a living when they're older, but it also asks them how they earn a living now.
Well, that's a very grounded way of looking at it. Now, we often ask kids what they want to be when they grow up, and they dream of being all kinds of things. But connecting what they want to be with how they earn money is smart, because it actually injects a bit of reality into that conversation.
You know, that's a great point. Now, to be clear, we're not saying that kids shouldn't have big dreams. They can still want to be astronauts, singers, basketball players, but kids don't always think about those things in terms of income. How those professions will help them cover their basic needs. You can dream of adventure and stardom, sure, but also think about how your future profession is going to provide you with the money that you need to live.
So in third grade, kids should learn about income. When do they learn about what to do with their income?
So that comes next. So the fourth grade lesson includes financial literacy basics, which covers everything from earning a paycheck to saving for retirement and all of the fun stuff in between.
Well, I imagine how much better off many seniors would be today if they learned about retirement planning in the fourth grade.
Yeah, no, that's very, very true. Many young working adults don't think that much about retirement. Learning about it earlier may prompt people to start saving earlier as well. This lesson also goes over needs versus wants again and asks kids to determine whether things like buying a bus pass, paying rent, adopting a pet, or going to the movies are needs or wants.
It makes a lot of sense to revisit needs versus want multiple times as kids grow, because many adults are very good at convincing themselves that things they want are actually needs. So the more you can reinforce that lesson when kids are young, the better.
Exactly. So the fourth grade is also a great time to introduce kids to the stock market. Now, this lesson just teaches kids about entrepreneurs, the difference between private and public companies, and initial public offerings. They also get to research real-life companies and keep track of their own little stock prices.
Well, that's great. Imagine how much less intimidated people would be about investing if they learned this young.
And that's especially true for women.
Right. Now, let's go over what kids should learn in the fifth grade.
Now, in the fifth grade, the lessons are all about jobs. They'll learn about exploring careers, the difference between a profession and a job, and how to write a resume. This is also a time to learn about education and training for that career.
I feel very confident about the child who has gone through all of these lessons. He or she is probably going to make some really good financial decisions down the road. Now, Ryan, remind our viewers where they can find these lessons.
So Investopedia's Financial Resource Center has all these lessons and more. We've really only scratched the surface today. Now, if you're an educator or a parent who wants to teach kids about financial matters, these ready-made lessons are a great place to start.
And this is a great place for us to stop. If you have questions about talking to kids about financial literacy, or if you have questions about your grown-up financial strategy, contact us at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with Estate Guru, we make estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. Call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.